everyone. Thank you very much for joining us today. My name is Corey Daharsh, and I am joined by Vinki Loomba. We are here to provide this educational webinar on conducting due diligence for limited partnership investing opportunities. A little bit about us. Again, my name is Corey Daharsh. I've been with Advanta IRA since 2016. So next month, I'm actually coming on 8 full years with the company. I've got a full lifetime career in the banking and finance world, and I currently work as a business development specialist. So I do these type of educational webinars. I do networking in my local area, and basically connect with anyone throughout the US or even outside the US that has a retirement account that would like to learn how to invest into alternative assets like limited partnerships or other types of asset classes you can hold in your retirement account. You just might have not known so. My guest speaker today is Vinki Loomba. She's the founder and CEO of Loomba Investment Group. She also has her own podcasts and webinars that covers a lot of educational topics as well. So I'm very happy to have Vinki today. She's got a wealth of knowledge and experience I'm very happy to share with you guys. Vinki, thank you so much for joining us.
Thanks, Corey. I really appreciate that. And I'm so looking forward to this webinar.
Perfect. Well, just a quick disclaimer for the audience. Advanta and Vinki, we're all here to provide educational information. This is not investment advice, and we're not here to endorse or promote any specific investment or type of investing. We're just here to share educational information and let you, as the nature of the webinar states, conduct your own due diligence and move forward as you see fit. So always be sure to consult with your own attorneys, accountants, financial advisors before you proceed with any specific investment. Specifically with self-directed investing, the self-direction portion is very important, making sure you've done thorough due diligence. And again, that's the nature of all of what we're talking about here today. So hopefully we'll give you some good information and feedback on how to do that as we go along. So a brief description of today's agenda. I'm going to cover who is Advanta IRA and what is a self-directed retirement account, basically how to utilize them and what they're established for, why investors choose to start self-directing. I'm going to have a very simple case study on how you could invest into a limited partnership, and then I'm going to turn it over to Vinki, who's going to cover mastering due diligence for these types of investment strategies, which again are limited partnership or LP investments into like syndication type investing or larger projects. We'll get into the real details of that later. As we're going along, I do want to let you know that the audience is going to be muted for today's webinar, but we do encourage your participation. So please use the questions box in the GoToWebinar panel. Ask any questions you have, as long as they relate to what we're speaking about. We'll go ahead and address them at that time. If they don't necessarily relate in the moment, at the end of Vinki's portion of the presentation, I'll go back through and read all the questions that came along, and we'll cover whatever you've had to ask. So please feel free to participate. We really encourage that. We're here to answer your questions and provide you great information. So the best way to do so is to know what you're thinking or know what you want to know. Additionally, I will state that this webinar is being recorded, and if you've signed up and you're participating live, you'll get a copy of this webinar emailed to you within about a day or two, and it will also go up on Advanta IRA's YouTube page, so you can pretty much find it any point in the future, watch it back at your own pace, pause it, rewind it, whatever you may need to do. And for all of our webinars, we do that. So anyone that you're interested in the future and maybe you don't have the availability to participate live, still sign up. You'll get a copy of the recording sent to you and you can check it out at your own pace. So just starting with who Advanta is, we are a self-directed IRA administrator. We also cover solo 401ks. We've been in the industry for over 20 years now. We have an active client base of around 13,000 clients, and we've got just over $3 billion in assets under management held by our clients. All of our clients' funds that are not actively invested are insured with FDIC and at appropriate institutions. And all of our clients are paired with a dedicated client account manager that's basically your go-to one-to-one point of contact. So you don't have to worry about having a retirement account with one of those larger custodians where every time you reach out, you have to speak with a new person and tell them who you are and what you're looking to do. I served in the account management role for 5 years, and it's a real great process where I got to learn who my clients were. And when I saw their phone call coming in or their email come in, I knew the appropriate way to answer things for them based on my relationship I built with that person. So we really try to offer great educational content as well as a great white glove customer service to all of our clients. If you've not heard about self-directed investing, it's actually pretty common. Only about 4% of US-based retirement accounts are self-directed, and that's an industry that's got about $40 trillion in it. So when you put that into perspective, there's only about $1.5 trillion or so that's actively being self-directed in an overall industry with $40 trillion in it. And that's really because a lot of people don't even know that self-directed investing exists. Most people have a fiduciary custodian or a financial advisor that has a vested interest in you thinking this is too risky or too scary and staying where you're paying them either a portion of the investments or paying them off of the profits that they yield for your investments is obviously in their best interest. Whereas the scary side of it is really just taking the matter into your own hands. And as long as you're conducting your due diligence thoroughly, as we're talking about today, why wouldn't you want to control and drive your own retirement dollars for the best income possible? So please feel free to let me know if you have any other questions about self-directing. If you think this would appeal to any of your friends or family members, please let them know as well. We're always trying to spread the word that self-direction exists and that there's plenty of different ways you could take advantage of it based on your own area of expertise or investment interests. There are a number of different types of plans that can be self-directed. So we have your traditional and Roth IRAs that most people are very familiar with. We also have SEP and simple IRAs for small business owners, solo 401ks, as I briefly referenced earlier, for small business owners that do not have any employees. Basically, if you're just running your own sole proprietorship or you've got your own startup with no W-2 wage earners, those are great plan types that have a much higher annual contribution limit and a few additional benefits beyond the traditional and Roth IRA. And then we also offer health savings and education savings accounts. So if you're someone with a high deductible health policy, or you have a young one in your life that you'd like to set aside some tax sheltered money for their educational expenses, those plan types are really great as well. Why do people choose to start self-directing? Well, I explained a little bit earlier, you first need to even know that it exists. So once you find out that it exists and you've already been doing some style of investing, maybe syndication investing as a limited partner out of your personal savings, learning that this exists and finding it to be a new source of capital is a key way that people start to switch over to self-direct. A lot of people are, as of recent, getting very fatigued with the stock market. I know over the past few days specifically, there's been some major turns and twists. So a lot of people are just getting tired of seeing that happen to their money and choosing to go the route, whether they're diversifying their portfolio or moving it all to self-direction to take more control. And then also the tax benefits. With these types of investments, you're keeping your real estate investments, and we're talking about limited partnership today, so that is aligned in the real estate class, in a tax deferred capacity. So no capital gains, there's no other taxes you necessarily have to pay with these types of investment strategies. These are also a great source of capital for a few different reasons, actually. It's very easy to repeat investments once you have an account. You can basically fund an investment, let it go full cycle, and once that does go full cycle, you can very easily move right back into the next investment with the same group or another provider, whatever you're doing your due diligence on and find to be viable. The returns are typically better than some of your base money market or CD type savings products. There's no outside approval needed. Again, the key term here is self-direction. You are making the final call on what you invest your retirement account into. And a lot of people with these types of accounts are not expecting to use the money anytime soon. So putting your money into an investment that has the expectation of a high return over the next 5 years, 10 years, may not be a problem for you because you're not planning to retire and start drawing out of your retirement account for 10, 15, 20 more years. So those are just a few reasons that these are a good source of capital for these types of investment strategies. Maybe one applies to you, maybe multiple apply to you. Really hoping that, again, if any questions come up, we can answer them for you. So please remember, if you have any questions, you can jot them down in the questions box. It's very important to invest with people you know. If you saw the video post I put up yesterday on my LinkedIn page, we're going to go a bit deeper, but we should start with that triad of know, like, and trust. Before you invest with anyone, You want to build that up. You want to make sure you know them, that you have references, and that you trust them, and that you like them too. The last thing you want to do is get into a 5-year or 10-year investment maybe with someone that you just don't align with on a personal level or a specific, direct interaction level. Sure, they may be great with money, but does that outweigh the benefit of having a good personal relationship with somebody? Usually not. So again, do your due diligence thoroughly, know, like, and trust the people you work with, build that network, ask for references. There's a lot of different things you can do before you enter an investment and tie yourself up with someone that's not the best fit for you. So as a real quick case study, I'm going to jump into how to invest as a limited partner with a retirement account, and then I'll turn it over to Vinki. In this deal, I've got a woman named Laura who's got funds in a retirement account that's currently with the managed custodian, and she meets a gentleman named Malcolm who is a general partner or a syndicator, and he has a large project going on that he's looking to raise capital for. So Laura and Malcolm meet. They discuss the investment offering. In this case, it's to purchase a local apartment building. Malcolm provides Laura with what's typically called the prospectus or the PPM in the subscription paperwork. She looks it over thoroughly and does her full due diligence and decides to make what would be the minimum investment, $50,000. These are rounded numbers, but they are reasonable and within the industry pretty straightforward to what you could expect. So I just want to share that. The numbers are a little bit rounded just for ease of the example, but they are reasonable as well. So Laura decides she does want to move forward. She sets up a self-direct account with Advanta and completes a transfer request so we can get the money moved over. In most cases, transferring money only takes about a week. And within that week after the account's open, we're also working to get the paperwork approved so that we can fund the investment as quickly as possible. We usually see brand new accounts open and investments funded within about 10 to 14 days max. And we can easily turn around an investment for an existing client if you've already got an account open within about 2 business days usually. So we start coordinating all of that on the back end. We've got Laura coordinating with her account manager to approve all the investment paperwork. And it's important to note that this paperwork's all in the name of the retirement account, not Laura individually. So everything's tied through the tax ID number for the retirement account, and nothing should have Laura's social security number on it to avoid any tax liability or consequence. Once the paperwork's all approved by Laura, Advanta's representatives execute the paperwork and fund the investment transaction. And the way this type of investment pans out is that the partnership pays an 8% preferred distribution to all subscribers. That's $4,000 a year on the $50,000 investment. After the 5th year, the project's refinanced and Laura's IRA receives a lump sum of $65,000 as a final payout. So in total, in addition to getting the full $50,000 she invested returned to her, she generated $20,000 total in yearly preferred distributions, plus a $15,000 profit at the end because this project went exceptionally well and the general partnership team did exactly as they had planned to do so, which Laura reviewed in her due diligence on that prospectus and investment packet. So that's just a general explanation of how this type of investment can take place. Laura can turn around and invest with that same group and Malcolm again. She can find another syndicator that's got a deal that she's interested in. But it's a very straightforward process, very simple. It's just a unique way to use your retirement funds outside of those publicly traded assets like stocks, bonds, and mutual funds. A few quick things before I turn over to Vinki. We do a lot of educational content. We've got a video library of all of our previous webinars. If you're in the Tampa, Atlanta, or North Carolina areas, we do in-person events pretty often. And we have a blog you could check out as well if you're looking at industry standard news. I know we're in an election year, and last election cycle, there was some legislation that was going through the circuits that was going to affect the self-directed investing industry. We were actually able to start a change.org petition and got enough signatures on that and got that portion of that legislation taken out. So we helped the movement of that piece of legislation out of the eventual item that was passed into law so that the negative effects were not there for the self-directed investment space. We also do a educational based networking platform on the final Friday of each month. So again, we're a self-directed administrator. We're not allowed to necessarily pitch or promote any specific deals. But if you are looking to pitch or promote a deal, or you're looking for your next investment, this is the call for you. It's Pitch, Promote, and Prosper. That's what the title of it is. It's the final Friday of each month, and everyone that signs in gets to give their elevator pitch of what they're looking for or what they have to offer, and network with the rest of the attendees from there. So if you are interested, please feel free to sign up. I believe August 30th is going to be the date of the next iteration of Pitch, Promote, Prosper. So the key takeaway points here, it's your retirement account, not you as the investor. So there's no personal tax liability. This is all routed through your retirement account. Syndication investing as a limited partner offers completely passive income, otherwise known as mailbox money. You do the due diligence on the deal, you hope that it's going to go as expected and planned, you put your money up for the deal, and then you just receive cash back in return, in addition to the return of your initial capital investment. And always conduct your due diligence thoroughly. You're in ultimate control with self-directed investing. And without further ado, I'm going to go ahead and turn it over to Vinki, and she's going to cover mastering the due diligence side for limited partnership investing.
Thank you, Corey. Thanks for having me today, first of all. And thank you, everybody, for joining us today. Like Corey mentioned, I do have a lot of educational stuff that I do at my end. I do a lot of webinars and meetups. And I really enjoy sharing my knowledge with everybody. So a small little disclaimer, my version, again, this is educational session, and we are not trying to sell anything. So don't consider it as a legal accounting or investment advice. This webinar does not represent an offer to sell or solicit any offer. So just take it as purely educational knowledge sharing session. Excuse me. Another thing I wanted to mention is I just got back from Bahamas. It's been 2 weeks, not just, but I'm still under the weather. So my voice is not 100%. So I might be coughing here or there. So if I take few pauses, please excuse me for that. So a little bit about myself. I come from a strong IT and academia background. I'm in California in San Francisco Bay Area for last almost 30 years. And I've been IT executive all my life, about 20 years plus. I was in the IT side of the house. And at the same time, I was an adjunct professor at California State University, teaching the grad program, the MBA and the executive MBA program. And I've been always on the education side. And that's why I think I love my job here too now when I'm in the entrepreneurship world, that I'm sharing my knowledge with everyone. So fast forward, I took a retirement a few years back, and then I wanted to support my nonprofit organization because that was my biggest why to step into real estate. So we had some small real estate portfolio back like 20 years back or more. We became default landlords between me and my husband, because when we built our second home, we rented the first one. That's how we learned about the passive income. Then we started going from there in the single family. But at one point, we realized between the 2 corporate jobs, 2 young kids, and lots of travel, we were not able to manage everything. So we started reducing our footprint there. But when I took the early retirement, I went back into real estate. This time it was a different focus, different purpose. And my wife was very strong. Like I told you, I have a nonprofit that gears towards women and children. And we wanted to support that organization. And our investors by default help us by investing with us, our nonprofit, which we really enjoy. My goal is to touch 1 million lives in this lifetime, even through the financial education or maybe my investors or through my philanthropic efforts. That's what I wanted to do. And that gives me so much happiness when I help people or share my knowledge. So let's move on to our today's topic, the due diligence. Go back to the first slide, Corey, please. Let's start with the bare basics. I know you might think you already know everything, and my goal here is to give you a little bit different perspective to look at things, because everybody has a different perspective. Everybody has their own conditioning, their own limitation, how they look at things. So when somebody comes and they share their perspective with them, all of a sudden, light bulb goes on. It's like, oh, wow, I didn't look at this way. So that's what we're going to be doing today a little bit. So let's talk about investing. What is investing? Everybody says I'm investing, but what exactly is investing? Investing is just like allocating resources, right? Taking your money and putting in a profitable venue, whether it's a stock market, it's a property, it's a commercial property, or even you can say these say digital currency, whatever, or gold, silver, whatever you like to do. The only definition I think of is putting your money to work to make more money for you. That's what I call it, investing. And then when you think about investing, you wanted to put your money to work. You wanted to think, why I wanted to do that. The purpose is very important. Like I was saying, my why is very important to me. And that's the reason I went into the investing world and formed this huge investment firm for myself, where I'm helping myself as well as I'm helping other people around me. So make sure that your why is aligned with your investing strategy. That's very, very important. And clearly defining your why helps you achieve your goals much faster because there's less hesitation. You're like more fluid. And the next one is where. Where do you want it to invest? The location, the asset class. You wanted to figure out what aligns with you. For me, it was real estate because I had the past experience and I was able to bring that experience into my current position and I was able to easily navigate that. So if you wanted to do that, sure, do that. If you don't have the past experience, just get the knowledge, increase your perspective, and learning that asset class wherever you wanted to invest is like really helpful. The next one is how. Strategy is important, like why. We talk about the where and why, and now how you wanted to do that. The strategy, how long the investment should be, 3 years, 5 years, 10 years, long term, 15 years. You wanted to figure that and define that strategy, because defining a strategy helps you focus. You can affect your portfolio. This super easy tweak things here, there. And if there's no clarity, it's going to be total hodgepodge. And the next one is who now. So who, when we talk about who you wanted to invest with, but before that, you wanted to understand the difference between the active investing and passive investing. Do you want it to be active investor? A lot of people like doing that. Active means, it involves a lot of buying, selling, or just kind of hands-on, You're doing everything yourself, wearing so many hats. A lot of people do not have that time because they have a full-time job or they wanted to enjoy life. They see things differently. They wanted to have time for their family or their life they wanted to live. So they choose to invest passively. Passively means you are taking the money and putting in a fund or a real estate syndication or a REIT or whatever the venues are that somebody else is managing it. You bring the money in and then you're just sitting back, relaxing or doing whatever you need to do or take care of your primary job. That's the difference between the two. So if you choose to invest passively, then the question comes who? So you wanted to identify the right partner. So we go through that, in the next few slides, how to do that. So can we move to the next slide, Corey?
Yep, Vinki, as I'm moving to the next slide, I just wanted to hit on one thing that you mentioned briefly. You got into what you're doing now alongside your husband. And that's something I see pretty commonly as I'm traveling and going to conferences. A lot of the nationally known speakers in this world of syndication and real estate investing are husband and wife couples. So is that something where you both had a shared interest, or maybe you pulled him more so into after he saw some of the success you were having, or vice versa? Can you maybe just expand on that, how you two as a team partnered together to do this type of investing?
Yeah, sure. We both come from the corporate world, actually. So we started together because when we built our second home, that was his idea because we were in a position to afford 2 homes or 2 mortgages. He's like, let's rent the first one. And that's how we started. So he was like 100% with me. starting day one. But now his focus more towards stock market, but still he helps me on the real estate. So we work together. And I think when your husband-wife team is like you have a kind of in-house support that works really well. And we both have 401k that we turn into our self-directed IRA accounts. And we started investing heavily from there as well.
Wonderful. Well, thank you for expanding on that a little bit. I'll let you turn back to the slides.
Okay, so I'm going to go back to the passive investing like I was talking about earlier. You know, when you're passive investing, you're investing with others, you know, you're letting somebody else do all the work from conception to completion, and you're just bringing the money on the table. And that's how passive investing works. And then when you're investing passively, I just feel like it leads to the financial independence. Because it just like earlier, Cody, you were talking about that. You said be on the driver's seat, which I love it, you know, because you need to be in charge for your own money. Because when you're putting your money with other custodians like Charles Schwab or Vitality, or in your 401k money is sitting. So think about that, you know, it's a bigger part, your smaller chunk goes in there. Somebody else is making money off of your money and just giving you the crumbs. And then, but if you take that money and you move into your self-directed IRA account or EQRP or whatever way where you can self-manage your money, you are in charge, and you can, you know, put your money anywhere to make more money, and then you're making more money. And why these bigger shops like Charles Schwab's or Fidelity, they don't allow the self-directed? I think Cody can talk more about that, just because they want you to make money off of your money. I think you mentioned that too a little bit. So
Yeah, well,
go ahead.
just to add there, it's not only that they want to make money off of your money, but it's also that they are fiduciaries or financial advisors. So in order for them to allow you to make these types of investments, they would have to commit the resources to do the full due diligence on your behalf. And we just genuinely don't see in the marketplace those larger companies like Vinki referenced wanting to put forth that energy, effort, and money and time value of money for someone on their staff to go do the thorough due diligence on these types of syndication deals. And there's one other aspect I wanted to mention while I'm speaking that Vinki touched on, but I wanted to expand on. When you're making passive investments, you are putting your money up, you're having trust and faith in another team that's actually doing the day-to-day operations for the deal. But it would be remiss if I didn't mention, they usually, almost all times that I've ever seen, are also passively investing into their own deals. So your money is also going alongside the money of those people that are managing the deal. So they, quote, have skin in the game as well in most, if not all, cases that I've ever seen. I just wanted to add that for the audience as well. It's not just your money going into someone else's hands. They usually have some of their own money in that deal as well.
Yeah, you said it very well, and then we'll go through that in the preceding slides as well, because that's the part of the due diligence, bigger part of the due diligence, because you wanted to ask that question to the operator, to the sponsor, or whosoever you're working with, how much their own money is going in the deal, because you wanted to make sure that they have skin in the game. And that's most of the time is the case, that everybody's putting their own money in the deal as well, because who doesn't want to make money, you know? It's like everybody's in the syndication process to make more money, and they wanted to allocate some resources there. So basically passive investing is indirect ownership in any deal that you're doing. And then whether it's a syndication or REIT, wherever you're investing, you're just bringing the money on the table and you're letting somebody else manage from conception to completion. And then can we go to the next slide? So I know I love passive investing because I've been doing it for multiple years, because I didn't want to do all the work by myself before becoming active. I was 100% passive. And then when we passively invest, you know, it gives you the time freedom, the financial freedom, the location freedom. Basically, you could be anywhere in the world, and you could still be getting your check. It's called mailbox money. I saw somewhere, or a lot of times we use that terminology. And then at the same time, you can live anywhere and you can invest anywhere, wherever, whatever market makes sense. And we're going to talk about that in the next slides too. So can you move on to the next slide, Corey, please? And then when I started investing passively, because I started investing in the syndication model, so what I realized was quickly, and that's the terminology I came up with, shared, because I saw that we're sharing all the resources. And then I felt like, oh my God, this is so good. I'm partnering with others. Partnering is important, right? Because it's giving me all the shared resources, and whether it's a financial burden or because there's going to be multiple people in the deal, right? If the deal goes south, something goes wrong, everybody's going to come in, join hands, and then we're going to be taking the hit together, maybe. That's the first hesitation people have in their mind. And after that is, we had the different skill sets, and not everybody knows everything. So I was able to leverage other people's skill set, because that's very important when you're going into something new arena and you wanted to walk in a new train, and then you wanted to have somebody to hold your hand. So that's what I felt like, it's kind of a shared environment. People are sharing the knowledge. If I didn't know something, somebody else knew, so I can leverage their knowledge. And that helped me move further much faster. And then I had more access to resources. So basically, I just felt like, oh my God, now I'm more resourceful, because when you're working with others, finding the right partners, you will have all of a sudden bigger network, because the people that they might know so many more people. So all those gonna be all of a sudden part of your network too, which allowed me to be more resourceful. And the next thing was the risk mitigation. It was just like, when you're working in a syndication environment, it's a team sport, and then not anybody can do alone. So when you're in that model, what happened was the risk is spread across multiple partners. So that kind of reduces the impact of potential losses. And then, and the benefit is kind of collective too. And then a lot of decision making and everything, we were just participating together. And I really started enjoying that culture. And I felt like, oh, this is really good. This is my way of doing things. And then when we're working together in a syndication, we have a better power, because the resources are allocated together, and it's like enhancing your buying power. You can buy bigger and better properties. And then, like I mentioned, responsibilities are distributed too, because we are multiple people in the team who are taking the a project from conception to completion. So that's why I like the syndication model. And I came up with this terminology, shared, because everything is shared and gives me peace of mind. And that's what I enjoy, being a passive investor or just being in the syndication process. Go to the next slide, please. And now the next thing comes, how to find the right partner. Okay, I like everything. Actually, I wanted to share one thing on the previous slide too, because the thing is, a lot of people, they think they wanted to do everything on their own, because most of us, we have this conditioning. We think we know everything, we can do it, we are capable of doing everything. But it's like one mind versus many when you're working in a shared environment, or you're working in a collaboration with others, and then you have more ideas, and you have more knowledge, and then better skill set to work together. And then, but the question comes now, how do I find the partners who I wanted to work with? And finding the right partner is very important. And then for that, finding the right partner, we have to understand ourselves, who we are first, because everybody is inexperienced. Like I told you earlier, that I might be sharing the same thing that you already know, but I want to give you a different perspective, because everything you do in your life is an experience. So when you're trying to invest or become an investor, that's another experience. So to become an investor, you wanted to create a certain experience for yourself. So in order to create that experience, you have to understand who you are and what kind of experience you want. And then you have to lay that out on the table, and you have to share with the other party, who's going to be your partner. It could be the operator, the syndicator, whosoever you want it to work, like what your vision is. And then, exactly what you're looking for in this investment, how long, how much money, what it's gonna look like, when you wanted to see the returns, when you wanted to get the updates, what kind of updates you wanted to see. And most of the investors, they wanted to see everything, good, bad, and ugly, because they are passive. But the thing is, they wanted to experience everything. A lot of times, some of the operators, they forget that. They just wanted to show them all the good stuff, to all the investors. They don't want it to share everything because remember I mentioned earlier that we all have this mentality, or we grew up this mentality that we can do it. So a lot of times operators and sponsors, they might think, oh, I think I can fix it, I can do it, I do not need to share at this point, which is a no-no. Because if an investor is investing with you, they are investing for experience. So let's say one investor, they invest 200,000, and then 5 years down the road, you give them 200,000 back, you double up the money. But if the investor didn't get the experience they were looking for, they're not gonna come back to you. They're not gonna go back to the same operator or the syndicator. So that's the reason you wanted to make sure that you have your vision alignment, whosoever you wanted to partner with. That's very, very important. And it's always good idea to put it out day one. And this is my requirement. That's exactly I'm looking for. And then hear the other person out, what they have to say, and then see if that makes sense to you, if that aligns. The other thing is you always wanted to know the person who you wanted to invest with. It's very important to know your potential partners. Take time to understand them, understand their background, their experience, their track record. We all come from different backgrounds. A lot of times we have a different upbringing, and then we have our own set of patterns that we follow because of our conditioning from the very childhood, because our upbringing is so different from each other. So all this, a societal pressure, parental pressure, I would say peer pressure, it kind of shapes us in certain way. And knowingly, unknowingly, we start following certain patterns, and we have certain expectations. We see things differently, the things the same way, because sometimes you are sharing something with somebody, but you do not know what the other person's understanding is, because they might be understanding something completely different than whatever you're trying to share. So that's the reason it's very, very important to understand your potential partners, where they're coming from. Do you really know them, who they are? And then do you like them? That's the other thing. Like does not mean that somebody's wearing this beautiful, red top or this nice trouser, and then you like them, or they look very good, their personality is appealing. So like, you wanted to know more than that. Like, do you understand how they act or interact? Do you like their behavior, their habits? So you wanted to take some time to understand that. And then finally is you wanted to and that comes to process, know, like, and trust. You're going to come to a point when you're going to feel, okay, I met this person one time, twice, 3 times, 4 times, now I just feel like, okay, I trust this person, let me dig more. And once you know somebody and like somebody, trust somebody, maybe that's the time to get to the next step. So let's go to the next slide, please. So the next slide is due diligence. That's what we're going to be talking about. I'm sorry, I wanted to set the base before we go into due diligence. So due diligence, what is exactly is due diligence? Everybody talks about it all the time. So due diligence is just like evaluating an investment, even I would say a person. You're evaluating, you're trying to see that this is the right fit for you. And then, like I said earlier, everybody's in for experience, and in life, everything is experience. So it does, when I say fit, it does not necessarily like, literal meaning of fitting. It's just like fits according to your experience, according to your expectation, or exactly what kind of experience you wanted to create for yourself. That's what the whole due diligence is. It's like that involves understanding yourself too, beside understanding the other person and the investment. So objective is to do the diligence to make sure that we understand all the aspects of the person, the investment, we fully understand, we assess that before making any kind of commitment. Because the goal is that we sleep peacefully at night and we are living the life. Because what happened is, I use this analogy all the time, in the chaos called life, most of the time, we forget to live because we are always in this or that. Or this thing happened, let me do this. Or that thing happened, let me do this thing. So all of our life, we're just doing this and that. And then life is just passing. Life is not gonna stop, it's keep on going. And we don't even live. And by the time we are our deathbed, I'm like, oh, I didn't even do anything. So That's the reason we wanted to do the due diligence, make sure that we are 100% right or close to 100% right, whatever we're trying to do, we have a peace of mind and we are living the life the way we want it. So can we go to the next slide, please? So due diligence, why you wanted to do it? I talk about that a little bit already. You do the risk mitigation with that. You make informed decision because you're comfortable, you have enough knowledge, you understand the process. You think that, okay, I'm going to give you one example over here. One of my investors, he lives close by where I live. And then he comes to our house every now and then to fix things. He's a good friend. And he used to hear me all the time sitting on the Zoom talking. And one day he asked me, he's like, what do you do? I'm like, I have an investment firm. We invest in the commercial real estate syndications. He's like, oh, I wanted to do that. I'm in real estate too. I have multiple homes. I'm like, okay. So he invested with me in one of my self-storage properties. And then he didn't know the process at the time. And he came a few times, talked to me, and I kept giving him all the information, whatever he needed. But he was like very nervous because he was not sure what he was doing. And then during that time, my daughter was getting married and we started renovating our house and everything. Since he lives close by and then he drives by our house almost every day. So I drove by our house and he saw a lot of people working at our house. So he panicked. And then he started calling me. I was in a meeting. I couldn't answer the phone. I texted him, I'll call you back. Then he called my husband. He's like, why Vinki's not answering my phone? I wanted to talk to her. What's going on? You guys are moving because you're renovating your house and everything. And my husband said, oh, no, we are not moving. Our daughter's getting married. So I called him and I'm like, what happened? He's like, oh, I invested my money with you and I'm just thinking you guys are moving from here, this and that. I'm like, oh, no, we are not moving. We are here, very much here. It's our daughter getting married, so we're getting our house renovated. But is there something I can help you with? And then he's like, oh yeah, I was just nervous. He didn't say anything. And after that, and I just made sure that I'm calling him every day or every other day, giving him the update on that. And finally, he got to learn about the process that it's going to take 3 to 5 years for the investment and it's going to give him the return at that time. And now he's like super chill. He doesn't even want to find out what's going on, because the thing is, before he didn't have enough knowledge. He did not know about the process. He just wanted to invest because he's our friend for last 10 years, 20 years. And then he invested. But once he learned all the process, he spent time to learn. After that, the hesitation went away, everything was fine. And that's the reason I tell all my investors, just make sure that you understand the process and understand how things work before getting into everything. Don't rush. There is no rush. There is always this deal or that deal. There's always going to be something. It's not like end of the world. Like if you didn't do it right now, it's not going to happen again. And then when you wanted to do the due diligence, the other thing is when you're going through the whole process, let's say if you're talking about the deal and everything, you wanted to understand how you're creating the value for yourself by investing. And also the legal compliance. These kind of things are very important, even though we go through with our investors, when this try to invest with us, and we do a lot of education on that. We take them through the whole process. But you keep on asking questions over and over again just to make sure that you have the peace of mind and you're sleeping at night. That's the reason we say due diligence is very, very critical. So go to the next slide, please. So key component of the due diligence is, I'll go to the next slide. The first one is the financial analysis. And financial analysis is very, very important because you wanted to understand the operators or sponsors' vision, like what they are trying to do with this particular investment or the asset class, whatever you're in. For example, if you're in a multifamily, what they're trying to do. What this, because every number in the financial statement, everything is telling you a story. So you have to look closely. You wanted to understand that the financial statement, what is telling you. So, and then it helps you to evaluate the investment, that what it's gonna look like over the course of 3 years, 5 years, 10 years, whatever they're giving you the timeline. And then it involves reviewing the financial profitability. You wanted to see what kind of debt they're getting, if it's a bridge debt or a fixed debt, what kind of interest rate, and then how long is interest only payment, and then what their plan is. Business plan is very, very important as well, and how they're allocating the resources, how they are, what are the uses for the financials, and how they're keeping the reserves if something goes wrong. So that will give you the whole story when you look at the financial analysis. So it's very important to look at the numbers, not just looking at the numbers that somebody tells you, I'm giving you 17% IRR, I'm giving you 9% pref, it'll give you 2x multiple. No, dig a little bit deeper. Next is the legal review. So you wanted to make sure that you do the legal review because it's a vital component of the due diligence. This involves checking for any legal issues or past litigation that could impact the investment. So that's the reason you wanted to make sure that there is nothing wrong with this particular person that you're trying to work. And then when you conduct a thorough legal review, you can identify any potential risk. And these days, internet is there, and now we have ChatGPT. There's multiple resources out there which can help you to go through or complete your legal review. I put a couple links over here for you. Like you can go to this public or government website for the public access to court electronic records. You can check that way. You can check the Google reviews, Google News or Google reviews for the person. I know things happen every now and then, but staying up to date is the best way you can do it. And then you can also review the partnership agreements and the compliance and regulatory. You can take to your, if you have an attorney, you can have them look it up for you. Or if you wanted to look at the financial, you can go to your CPA. You can use all the resources that you already have under your belt as well. Go to the next slide, please.
And Vinki, I just had a quick question on the legal issues and past litigations. I'm assuming that reviewing that doesn't necessarily constitute a deal breaker. As you mentioned, things may have happened in the past, but do you often see syndicators be upfront and let their potential investors know ahead of time, like, hey, this occurred, here's my explanation or description of my side of this potential thing that's going to come up when you do your due diligence? Or do they more so wait until you find it to address that, just in your experience as a limited partnership investor?
No, usually they tell you upfront. And they tell you if the deal went bad or something, they tell you they did capital call, they do that. And you have all the right to ask the questions too. Most of the operators, good, savvy operators, they like to tell you everything upfront. And then I think as part of the due diligence for the passive investor, I ask the operators who I invest with, I will always ask them, did you do any capital call, any legal issues, anything like that? And they tell you, they're very transparent. Most of the time, everybody's very, very transparent. And if they're not, you might want to run away from that. You don't want to get into that situation that you have to do yourself. But this is like one of the important steps. So I just wanted to highlight that whether you do it or ask the question, make sure that you're 100% clear on that.
Perfect, thank you.
And the next one is the track record evaluation. Is very important. Track record, whosoever you wanted to invest with passively, you wanted to assess their past performance, not just how many deals they have done. You wanted to know how the deals have performed. That's very important because usually you'll find all this information in the operating memorandum or the OM you call. They put it out there. I have done these many deals, I have done these many full cycles, so all the information is there. And then just ask them how the deals perform. Anything is not working for you, and these days, especially in this kind of market, it's very important to ask how the deals are doing so far. Did you pause any distributions? Did you do any capital calls? And how the investor sentiment is for you at this time. This is very, very important. And also you might want to ask them, have you done, how are you doing in the similar investments, if you have done any in the past? And then our returns already touched on that. Did you pause the returns? And a lot of people or a lot of syndicators, they are pausing the returns because they wanted to have the reserve. And we have done on a couple of our deals too, because we wanted to have enough reserve. We are looking to refinance our deals toward the end of the year. So we don't want it to do any capital calls. We wanted to make sure there's some reserves, and then we go very smoothly, and then we are hitting our targets for us. And also you wanted to ask them, how they are managing the properties. Is there any mismanagement, or they're working with a property management company? I know it happened to us in one of our deals. We had a huge issue with our property management, and then we switched our property management company 3 times, believe me or not. And in that whole chaos, the deal was not doing really well. And then as a team, we got together. It was part of our portfolio. That was the other reason. So as a team, we got together, and then we figured out where the gaps were, where things were not happening very the way we expected. So we corrected all that, brought a new property management on board, and then we were able to sell that property within months. And then we were able to give the money back to our investors. We gave like more than 50% return back to our investors, and the other, we used it for the other properties in the portfolio to stabilize those properties. So those things can happen in the timeline. Let's say if the deal is for 3 to 5 years, it's a 5-year hold. So there's going to be some up and down, as long as the operating team, they know, the management team, they know how to manage the property, and they can bring that back on the track. That's more important than versus, okay, I gave the returns, or or I have maybe 20 syndications, or I have 5,000 units or 10,000 units. More important is the management team, what their management style is, or how bullish they are on the deals that they're taking down. Do they have the potential to bring the deals back online or back on track if something goes wrong? Next one, please. So conduct background checks is very important, and we do that for all our syndicators, operators who we work with. We wanted to make sure that we do the background checks, and if there's any red flags and any negative feedback, because when you're in this industry, you're talking to people, talk to the past investors, talk to the other partners, and then understand who this person is, or what this team look like who you're trying to invest with. Next one, please. Review reference, like I was saying, you wanted to verify their work history, and also feedback from the previous partners. And also it's important to check their testimonials, how people think about that, because it's important for you to know that you can trust this person, or you wanted to have the relationship with this person for the next 3 to 5 years. Basically, you're getting marriage, and it's a long trip to make it a good experience for yourself, like I said in the very beginning, because everything we do for experience. If we don't have a good experience, if we are not enjoying the process, we're not gonna be happy. Because don't worry about the end result. End result is gonna be good or bad, whatever it's gonna be, but enjoy the journey. As long as you're enjoying the journey, the result is gonna be good as well. Next slide, please. So management assessment, like I mentioned a little bit, I touch on that. It's very important to assessing the management style, their communication style, how they're communicating with, not just with you only, because, I'm like, for me, I just feel like if somebody's talking to me nicely, because maybe they think that I'll invest with them, maybe now or later. But I just wanted to know the complete open communication style that they have, and that includes on maybe communication on the investment itself, like how soon they start the the updates on that, or how frequent they are with their updates, and how much they are communicating to the investors. That's very, very important. Other than that, I just believe in the clear communications to understand the whole process, and I wanted to know how they are communicating with the team, the other members of the team. Are they good with everybody in general? Are they bad mouthing anybody, or are they saying, oh, they're just like the problem solvers? versus, troublemakers like saying, or just always thinking, oh my God, this is so big, I don't know how I'm going to do this, versus saying, oh, it's nothing, let me see, let's find a solution to fix this thing. So all those kind of things are important to me. And then, like I mentioned earlier, I don't want to know how many deals they have done. It's important to me how these deals have been performed over the course of time and how exactly they're managing the investors or deals, like overall in all their communication style or management style. Are they keeping everybody appraised? Are they same all the time? Or they losing temper or every little thing? Because if people are doing that, losing the temper on every little thing, they might not be that good managers overall, because they're gonna lose their cool when something wrong happens. And some people, if something goes wrong, they're always cool. Like I can give you this example over here. Like, let's say I was actually, we were going to India a few years back, and then it happened to us. There was a turbulence, and it was long turbulence in the plane. So at that time, we were thinking, oh my God, what's gonna happen? And the seatbelt sign was on. Everybody was wearing a seatbelt, and everybody was so tight. And this lady sitting next to me on the other aisle, she was so scared. She was holding onto the seat so tight, and she was just trembling. I'm like, what happened? I'm just trying to calm her down. She's like, oh, I don't like flights, And on top of that, this turbulence. And then what happened? Within minutes, the captain was out and he started telling us about the weather, the turbulence, and everything. So everybody was kind of calm a little bit in the plane. So I was thinking that on the real estate side, if something like that happens in real estate, if we bring that scenario into real estate, and then if there's a turbulence, like the market went down or something happened to the deal, and if the syndicator or the operator goes completely quiet, what happens? There's going to be whole chaos. All the investors going to be panicking. They're not going to like that. Versus if the operator comes out and they're communicating day one, telling everybody what's going on, if something sudden happens to, and they are experienced, and they will come out and tell you exactly what happened, and they have a whole plan how to get out of that. Those are kind of management styles I like, and I think those are the kind of things that are really important to look for when you're investing with somebody. Market analysis, usually all the pitch decks, they do have a lot of information about the market, because most of the syndicators and operators, they do a lot of market research when they bring the deal or get into a deal. And because it's very hard to find a deal, I'm going to tell you, it's very easy to find the money, but it's very, very hard to find the good deal. And that's the reason operators, they work really, really hard. It's just like finding a good deal is finding a needle in the haystack. So they take their sweet time to find the right market, right deal. But what you can do is, when they give you the whole pitch deck, you can take all the information there, and then there's multiple resources out there, and you can double check all that information as part of your due diligence. And like, you can go to CBRE or Marcus Millichap, you can go to the city data, Google Maps. If you wanted to check the rent, you can go apartments.com, and then you can validate all that information for yourself, so you feel comfortable that whatever information that you're provided with, that information aligned with all the resources wherever you're checking. So now the question comes, where to find the partners, right? For that, these kind of webinars like you're here, you can connect with people, and you can go to the networking events, whether in person or Zoom. You can go to the business workshops, and there's a lot of online platforms too, like I think Left Field Investor, one of those, they're like a really big one these days. There are multiple other networking groups that you can join and start talking to people. The best thing is just go out, talk to people, meet people, share knowledge, and understand where you align and where you're going to get the experience that you're looking for. And then you can leverage your own personal and professional network as well, and see who's doing what, who's investing there, what kind of investments they are doing, or where they're interested, and see if you can leverage that network and make connections from there. Next one, please. Okay, so I would say the three things are very, very important in the end, that when you're seeking the partners, the track record in all the areas, all across the board. You want to understand that according to your understanding, and then please understand, your understanding could be totally different than me or anybody else out there. So as long as that understanding fits into your experience, that's what you're going to exactly look for. It could be more or less, but as long as you're comfortable, that's the best due diligence for you. And then handling conflict and disagreements, you wanted to make sure that for that you need to have the know, like, trust relationship, and then you need to know how the other person is handling all that. Then you're getting into a long-term relationship with somebody. Like I said earlier, it's like kind of a marriage for 5 years, 10 years, how so long the deal is. You wanted to make sure that you like this person, you know this person, you trust this person, you can talk to this person. That's the most important thing that people forget, that you can talk to this person, you can communicate at the level that you want. Then it's the right partnership for you. Calls that you wanted to avoid, never go for a deal just like for the returns. It says 20% IRR or 30% AR. No, you never wanted to neglect your due diligence. No matter how sweet the deal is, you wanted to do your due diligence, make sure you're 100% sure what you're getting into, and do not ignore any red flags. Ignoring red flags, I mean, is when you're talking to people, listen carefully what they're trying to say, and then you'll find certain things in there that people are going to tell you themselves, you know. So make sure that you're listening into those kind of things as well when you're looking for the red flags, and make sure that there's no red flags or you're comfortable if you wanted to ignore something. And then lack of diversification or overestimating returns, you make sure that all those things are covered in the OM, and also is aligning to your vision, whatever you want it to do. Is it, you know, it's gonna add to the diversification of your portfolio, or is the returns are overestimated? That's the reason you wanted to do the financial analysis. And you don't want it to overestimate for yourself either, because sometimes what happens is, you know, they say, I'm gonna give you 8% cash on cash or 9% pref, right? Sometimes you're doing your own calculation and some things does not work. Sometimes things get overestimated for you as well. So you wanted to make sure you are in line with that, not overestimating yourself either, as well as the sponsor is not doing that job, and it's like really clean understanding there. And the communication is the key. Like I mentioned multiple times before, communication is the best key. Ask question, ask as many questions. The question that you do not know the answer to is always the right question, because a lot of people, they say, I don't ask because I don't think it's the right question. I'm like, if you do not know the answer, that's the right question. It does not matter what other person's gonna think, because it's your understanding. You wanted to be in charge, like Corey said in the very beginning, that you always wanted to be on the driver's seat, because it's your money, it's your vision, it's your experience, created the way you wanted to create it. I think this is it. This is the last slide, right?
Yep, that was the last slide. I'll just put Vinki's contact information up here and give the audience another minute or two. If you have any final questions, please feel free to jot them in the questions box. We'll be happy to answer them before we wrap up. We are right at the hour mark, so thank you all for your time and your interest in today's presentation. I hope that you were able to glean some good knowledge about due diligence and some of the great expert advice from Vinki as to where to look, what to do, what to think about, what to make sure you double check, and not leaving any stone unturned as it relates to due diligence. Because again, self-direction, or even if you're not using a retirement account, you want to make sure you're thoroughly comfortable before you enter an investment, because even when you are thoroughly comfortable, something may not go to plan, and you should fully understand the contingencies if that be the case. And that will all be outlined in the investment prospectus or memorandum regarding what they plan to do if something doesn't go the way they expect to, and what the ideal scenario is. And don't get tied up into seeing what the expected rates of returns are going to be, because it may not come to play where it actually works out that way. So this is a real good risk mitigation factor, thoroughly understanding your due diligence and doing extremely thorough due diligence. So appreciate everyone for your interest in today's topic. And thanks again to Vinki for coming on and sharing her wealth of knowledge and expertise with everybody. Vinki, thank you so much. Any final words for you?
No, thank you so much, Corey. Thanks for having me. And I really enjoying sharing my knowledge. The only thing I wanted to say here is like I say to everybody, you know, in the chaos called life, don't forget to live. So carve out your life, create the experience that you wanted to create. And that's the reason I say due diligence is must in every aspect of your life, whatever you're doing, not just the investments, you know. You want it to be 100% sure whatever you're getting into or whatever you're trying to do or accomplish for yourself.
Wonderful. I think that's a great closing piece of advice. Above and beyond the investment expertise, just don't forget to live and kind of cherish the moments throughout the day. There was someone that said they had to leave early in the questions box, but they did say that they plan to reach out to you for a one-to-one call. So I'll look forward to hopefully that going well with you both. And everyone else, please enjoy the rest of your day. I hope to see you on the next educational webinar, and that'll be it. Thank you so much.
Yeah, thank you again, Corey. And if anybody like to reach out, my information is there. Please feel free to reach out. I would love to connect with you and explore further possibilities. Thanks again, Corey.
You're very welcome, Vinki. All right, we'll see you all next time. Thank you.